projected 25% decline in real estate, manufacturing and technology sectors by Q2 2025, global competitors positioning themselves for market share amidst China's economic turmoil. Date: January 30, 2025. Economic context and projections. China's economic landscape is currently characterized by significant challenges, leading to projections of a 25% decline in key sectors such as real estate, manufacturing and technology by the second quarter of 2025. GDP growth estimates for 2024 are disappointingly low, ranging from 2.4% to 2.8%, markedly below the government's targets. The stagnation of the property market, highlighted by a staggering 23% decline in new construction starts in 2024, has severely impacted local government investments and consumer spending. Analysts caution that without urgent measures to stimulate demand, growth in 2025 could be limited to a mere 3% to 4.5%. Sector-specific impacts. Real estate. The commercial real estate sector is poised for a considerable downturn. High interest rates and evolving tenant needs contribute to this bleak outlook. A recent Deloitte survey indicates a shift among industry leaders from pessimism to cautious optimism. 88% of respondents anticipate revenue increases in 2025. However, this optimism is tempered by concerns regarding high vacancy rates and refinancing risks. The ongoing property crisis underpins a broader economic malaise, signaling that recovery will be slow and fraught with challenges. Manufacturing. China remains a global manufacturing powerhouse, contributing approximately 30% of global output. However, rising labor costs and decreasing foreign direct investment (FDI) pose significant hurdles. In 2024, FDI in manufacturing was recorded at 221.21 billion renminbi, reflecting a cautious stance among foreign investors amid economic uncertainty. Despite a nominal growth of 6% in the manufacturing GDP during 2024, the sector struggles under the weight of external pressures, including geopolitical tensions and global supply chain disruptions. Technology. The global technology landscape is undergoing rapid transformation as firms reassess their reliance on China. Geopolitical tensions coupled with unpredictable market conditions in China are pushing multinational corporations to adapt their supply chains and production bases. The technology sector is expected to be heavily influenced by the unfolding dynamics, with companies seeking to capture market share in alternative regions. Common themes across sources. 1. Economic decline. All reports highlight a looming 25% decline across critical sectors due to China's faltering economic indicators. 2. Global competitor strategies. Multinational companies are recalibrating their strategies to seize market share, particularly in manufacturing and technology, as they pivot away from dependency on China. 3. Impact of interest rates. Persistent high interest rates are universally acknowledged as a significant obstacle affecting investment decisions and financial performance across sectors. Divergence in perspectives. While some analyses emphasize the resilience of China's manufacturing sector regarding FDI and exports, others underscore a more pessimistic view, particularly concerning the real estate and technology sectors. This disparity reflects varying interpretations of China's economic health and the potential for recovery. Timeline of key events. 2022 to 2023, China's economy experiences a slowdown primarily driven by the collapse of the property market. 2024, modest GDP growth of 2.4% to 2.8% is observed alongside significant declines in property investment and local government spending. Q2 2025 projections. A predicted 25% decline across key sectors prompts global competitors to adapt and reposition themselves in anticipation of capturing market share as China's economic outlook remains grim. Global competitors' positioning. In light of these challenges, global competitors are strategically maneuvering to capitalize on the shifts in market dynamics. Industries are increasingly looking to diversify their supply chains, reduce dependence on Chinese manufacturing, and explore opportunities in emerging markets. As China grapples with its economic woes, countries like India, Vietnam, and Mexico are positioning themselves as viable alternatives for manufacturing and technology investments. Conclusion: the projected decline in China's real estate, manufacturing, and technology sectors is reshaping the competitive landscape on a global scale. As multinational corporations realign their strategies to adapt to economic uncertainties, the emphasis will be on leveraging new opportunities in alternative markets. The path to recovery for China remains uncertain, and the international community will closely monitor developments as they unfold in the coming years. The implications for global trade, investment, and economic stability are profound, warranting strategic foresight and agility from businesses worldwide. The content contains several counterintuitive elements regarding the projected decline in the real estate, manufacturing, and technology sectors in China and the global reactions to it. Here are the identified counterintuitive pieces of information. 1. Optimism amidst decline. Despite the projected 25% decline in key sectors, a significant portion of the commercial real estate sector is displaying optimism. For instance, a Deloitte survey noted that 88% of real estate executives expect revenue increases in 2025, a stark contrast to the ongoing economic turmoil and high vacancy rates. This optimistic outlook, given the context of economic decline, is counterintuitive. 2. FDI resilience in manufacturing. While the manufacturing sector is experiencing a decline in foreign direct investment (FDI), which reached 221.21 billion renminbi in 2024, it still accounts for a substantial 30% of global output. This highlights a paradox where a sector can be crucial to global supply chains and still experience a downturn in investment confidence due to domestic economic challenges. 3. Consumer confidence discrepancy. Although official statistics suggest household consumption growth, other indicators reveal a contrasting picture. For example, real per capita household expenditure is reportedly expanding, but retail sales growth is sluggish, suggesting that the perceived confidence may not accurately reflect the actual economic behavior of consumers, which is counterintuitive to the narrative of recovery. 4. Interest rate impact. The anticipated decline in the economy is largely attributed to elevated interest rates affecting investment decisions across sectors. However, the optimism noted among real estate executives suggests that the market is expecting a rebound despite these high rates, which typically would deter investment. This discrepancy between expected economic conditions and sector-specific optimism is noteworthy. 5. Government spending versus economic growth. The government is projected to increase fiscal spending, which is expected to contribute positively to growth in 2025. However, the structural issues and local government debt problems suggest that this additional spending may not effectively stimulate the economy, raising questions about the effectiveness of such measures in the face of systemic economic challenges. 6. Contradictory global strategies. Global competitors are repositioning themselves to capture market share in manufacturing and technology, suggesting a flight from reliance on China. Yet the manufacturing sector in China still attracts significant foreign investment due to its unique advantages, creating a tension between declining confidence and persistent investment attraction. 7. Technological investments. Despite economic woes, the emphasis on technological advancements and the integration of AI within the real estate sector indicates that players are looking to innovate and improve efficiency amidst downturns. This contrasts with the expectation that economic downturns would lead to a tightening of investment in innovation and technology. 8. Long-term versus short-term projections. The projections for a modest economic recovery in 2025, despite significant structural weaknesses in the economy, suggest that expectations of recovery may be overly optimistic, contradicting the dire current economic indicators. This belief in a rebound without substantial foundational changes raises questions about the reliability of such forecasts. 9. Consumer spending versus economic support. the government's push to enhance household consumption through subsidies and support may contradict the reality of a deleveraging process taking place among households. This disconnect between policy intentions and actual consumer behavior reflects a counterintuitive situation where efforts to stimulate consumption may not yield expected results. 10. Global perception of China's economic health. The perception that China's economy is stabilizing or recovering despite significant structural issues and declining growth rates illustrates a counterintuitive narrative. Analysts and international observers may continue to view China as a resilient economy even when the underlying data suggests otherwise. In summary, the counterintuitive elements in the projected decline of key sectors in China highlight the complexities of economic perceptions, investment behaviors, and the interplay of optimism amidst adversity. These contradictions can lead to an oversimplified understanding of the economic landscape, necessitating a nuanced approach to analysis and forecasting. The report projects a significant decline of 25% in the real estate, manufacturing, and technology sectors in China by Q2 2025. This decline is largely attributed to ongoing economic turmoil within China, characterized by sluggish GDP growth and a collapsing property market. As China grapples with these challenges, global competitors are strategically positioning themselves to capture market share, which presents both risks and opportunities in the landscape of international trade and investment. Key content often overlooked. 1. Authority bias in economic data. Many people may underestimate the impact of authority bias when interpreting China's official economic statistics. The report emphasizes that China's government often presents a narrative of economic resilience, selectively highlighting positive indicators while downplaying or omitting unfavorable data. This selective reporting creates a distorted perception of the economic reality, leading analysts and investors to make decisions based on inflated figures. Understanding the credibility of these statistics is crucial for both domestic and international stakeholders, as it directly influences investment strategies and policy decisions. Significance: recognizing authority bias is essential for accurately assessing China's economic health and its implications for global markets. Investors who rely solely on official data may be misled, potentially leading to misguided investments or missed opportunities in alternative markets. 2. Structural issues in the real estate sector. While the report discusses the projected downturn in the commercial real estate market, it also highlights underlying structural issues that may not receive as much attention. These include high vacancy rates, refinancing risks, and the impact of elevated interest rates. The Deloitte survey reveals a shift from pessimism to cautious optimism among real estate executives, with 88% expecting revenue increases despite ongoing challenges. Significance: the real estate sector's struggles are symptomatic of broader economic challenges, including local government fiscal pressures and consumer confidence. Investors should consider these structural factors when evaluating potential recovery scenarios, as they could affect the speed and sustainability of any rebound in the real estate market. 3. Geopolitical implications for manufacturing. The report outlines that China remains a critical player in global manufacturing, contributing around 30% of global output. However, rising labor costs, declining foreign direct investment (FDI), and geopolitical tensions are reshaping the landscape. While some analysts may focus on China's manufacturing resilience, the report indicates that multinational companies are actively seeking alternatives to reduce their dependence on China. Significance: understanding the geopolitical context is vital for investors, as shifts in manufacturing bases could lead to significant changes in supply chains and market dynamics. Companies that adapt to these geopolitical realities may gain competitive advantages, while those that fail to respond may face disruptions. 4. Impact of elevated interest rates. The report notes that elevated interest rates are universally acknowledged as a significant challenge across key sectors, particularly real estate and manufacturing. However, the nuanced implications of prolonged high rates on consumer spending, investment decisions, and overall economic growth are often overlooked. The correlation between interest rates and investment behavior is critical as businesses may become more risk-averse in a high-rate environment. Significance: elevated interest rates can stifle growth and investment, compounding existing economic issues. Investors should closely monitor interest rate trends and their potential impact on sector performance, particularly in capital-intensive industries like manufacturing and real estate. 5. Technological shifts and supply chain reconfigurations. The technology sector is experiencing a notable shift as global firms anticipate changes to supply chains and production bases due to geopolitical tensions and economic uncertainty in China. While many focus on the immediate financial implications, the longer-term strategic realignments may be overlooked. Companies are likely to seek more stable and predictable environments for their operations, which could lead to significant shifts in global supply chains. Significance: the reconfiguration of supply chains presents both risks and opportunities for investors. Companies that proactively adapt to these changes by diversifying their supply chains or investing in emerging markets may be better positioned for growth. 6. Consumer confidence and household consumption. The report touches on the importance of consumer confidence in driving economic recovery. Yet it may not fully capture the complexities of household consumption dynamics. With sluggish wage growth and a cautious consumer sentiment, household consumption may not rebound as expected, impacting overall GDP growth. Significance: understanding the interplay between consumer confidence and economic growth is crucial for forecasting recovery. If consumer spending remains weak, it could hinder recovery efforts across multiple sectors, further complicating investment strategies. Conclusion: in summary, while the projected decline in China's real estate, manufacturing, and technology sectors by Q2 2025 is alarming, several nuanced factors may be overlooked by many observers. The significance of authority bias, structural issues in real estate, geopolitical implications, elevated interest rates, technological shifts, and consumer confidence dynamics all play a critical role in shaping the narrative around China's economic trajectory. Investors and stakeholders must navigate these complexities to make informed decisions in a rapidly evolving global landscape. By doing so, they can better position themselves to capitalize on emerging opportunities while mitigating potential risks associated with China's economic challenges. 1. Economic context and projections. The projected 25% decline in China's real estate, manufacturing, and technology sectors by Q2 2025 is a critical indicator of the country's economic health. With GDP growth estimates for 2024 hovering between 2.4% to 2.8%, significantly below official targets, the stagnating property market is at the core of these struggles. A decline in new construction starts and the looming refinancing risks, particularly in commercial real estate, highlight the fragility of the economic landscape. Global competitors are recalibrating their strategies to capture market share, indicating a potential shift in the global economic balance as they seek alternatives to reliance on China's economy. 2. Sector-specific impacts. Analyzing the implications for specific sectors reveals distinct challenges. The real estate sector is grappling with high vacancy rates and elevated interest rates, while the manufacturing sector faces rising labor costs and declining foreign direct investment. The technology sector too is seeing shifts in supply chains and production bases amid geopolitical tensions. These sector-specific dynamics not only affect local and global investors but also redefine how firms strategize for resilience and growth in a changing economic environment. 3. Global competitor strategies. The response of multinational companies to the declining sectors in China underscores a critical theme of adaptive strategies. As companies pivot to capture market share, they are exploring alternative manufacturing hubs and supply chain realignments. This strategic repositioning is not merely a reaction to China's economic turmoil but signals a broader trend towards diversification and risk mitigation in global supply chains. The emphasis on alternative markets indicates a significant shift in how businesses view their operational landscapes and competitive advantages in a volatile global economy. For interest rates and investment decisions, elevated interest rates are a common theme affecting all sectors under discussion. These rates challenge investment decisions and financial performance, making it crucial for companies to navigate their financing strategies carefully. The expected economic environment characterized by potentially stabilizing conditions in 2025 calls for a reassessment of capital allocation strategies. Companies must balance the current cost of capital with future growth opportunities, making financial prudence essential in their decision-making processes as they plan for recovery and growth in the aftermath of economic decline. These 4 points provide a framework for in-depth analysis and discussion about the implications of the projected decline in China's economic sectors and the strategies employed by global competitors in response to these challenges. 1. The Great Depression 1929 to 1939. The Great Depression was one of the most severe economic downturns in modern history, beginning with the stock market crash in October 1929. This financial collapse led to widespread bank failures, massive unemployment, and a significant decline in industrial output and international trade. The impact on the real estate market was profound as property values plummeted, leading to foreclosures and a slowdown in construction. In response, governments worldwide implemented various economic policies and stimulus measures to stabilize and revitalize their economies. Much like the current global competitors adjusting strategies in anticipation of a decline in China's economy. 2. The Asian financial crisis 1997 to 1998. Originating in Thailand with the collapse of the Thai baht, this crisis rapidly spread to other Asian economies, leading to severe economic downturns in countries like Indonesia, South Korea, and Malaysia. The crisis was characterized by a sharp decline in currencies, stock markets, and real estate values across the region. Similar to the current projections for a decline in China's sectors, the Asian financial crisis prompted global competitors to reassess their positions in Asian markets, leading to shifts in foreign direct investment and manufacturing strategies as countries sought to regain economic stability and market share. 3. The 2008 global financial crisis, triggered by the collapse of the housing bubble in the United States. This crisis led to a severe global recession. The interconnectedness of the global economy meant that financial institutions worldwide were affected, leading to bank failures, drastic declines in consumer wealth, and a significant drop in economic activity. The real estate sector was particularly hard hit, with a wave of foreclosures and a steep decline in property values. In response, governments and financial institutions worldwide implemented various monetary and fiscal policies to stabilize their economies. This scenario parallels the current situation where global competitors are positioning themselves to capture market share amidst China's economic turmoil and anticipated declines in key sectors. Future outlook: predictions for the global economic landscape by Q2 2025. As we look toward the future, the global economic landscape is poised for significant shifts, particularly in light of the anticipated 25% decline in key sectors such as real estate, manufacturing, and technology by Q2 2025. Driven by China's ongoing economic turmoil. This scenario compels global competitors to strategize for enhanced market share amidst the challenges posed by the world's second-largest economy. 1. Economic growth projections. China is grappling with a substantial slowdown, with GDP growth estimates for 2024 hovering between 2.4% to 2.8%, clearly falling short of official targets. Such economic stagnation, primarily attributed to a collapsing real estate market and declining foreign investment, raises concerns about China's ability to recover. Analysts predict that if demand stimulation measures are not enacted swiftly, GDP growth in 2025 may barely reach 3 to 4.5%. This scenario sets the stage for a sluggish economic environment, with implications for global markets heavily reliant on Chinese demand. 2. Sector-specific declines. Real estate. The commercial real estate sector is likely to witness a drastic downturn, with high vacancy rates and refinancing risks exacerbated by elevated interest rates. A Deloitte survey indicates a cautious optimism among 88% of respondents who foresee revenue increases in 2025, yet this optimism does not mask the current challenges confronting the sector. Manufacturing, China accounting for about 30% of global manufacturing output faces rising labor costs and declining foreign direct investment. In 2024, FDI in manufacturing dropped to 221.21 billion renminbi, reflecting investor caution. The anticipated decline in this sector could push multinational companies to seek alternative manufacturing bases, potentially in regions like Southeast Asia or India, as they pivot away from China. Technology, geopolitical tensions, and supply chain disruptions are prompting global tech firms to reassess their reliance on Chinese manufacturing. As firms reposition themselves, there is a likelihood of increased investment in technology sectors that focus on innovation and sustainability outside China. 3. Global competitors' strategies. In response to China's economic challenges, global competitors are expected to adopt aggressive strategies to capture market share. Diversification of supply chains. Companies are likely to accelerate the diversification of their supply chains, reducing dependency on Chinese production. This could lead to increased manufacturing activity in countries such as Vietnam, India, and Mexico, which offer competitive labor costs and favorable trade agreements. Investment in technology and innovation. Firms will prioritize investments in technology to enhance operational efficiencies and reduce costs. The push for digital transformation and AI adoption across industries will become paramount as companies seek to leverage technology for competitive advantage. Sustainability initiatives. As the global focus shifts towards sustainability, companies will increasingly invest in green technologies and sustainable practices. This will not only help in compliance with emerging regulations but also cater to the changing consumer preferences for environmentally friendly products. 4. Interest rates and economic policies. The economic landscape in 2025 will be significantly influenced by interest rate policies enacted by central banks around the world. Following a period of elevated rates, there is speculation that central banks, particularly in the US and Europe, may begin to loosen monetary policies to stimulate growth. Such actions could alleviate some pressures on the real estate and manufacturing sectors, potentially leading to a modest recovery. 5. Consumer confidence and household spending. Amidst these shifting dynamics, consumer confidence will play a critical role in economic recovery. The Chinese government has indicated a commitment to boosting household consumption, which will be crucial for driving economic growth. However, consumer sentiment remains fragile, particularly in light of deflationary pressures and job market instability. Policymakers will need to implement effective measures to restore consumer confidence and stimulate spending. 6. Geopolitical factors. Geopolitical tensions, particularly between the US and China, will continue to shape economic interactions globally. Increased tariffs and trade barriers could further complicate China's recovery and impact the global supply chain. Businesses will need to navigate these complexities, potentially leading to a realignment of international trade relationships. 7. Long-term structural changes. The forecasted declines across vital sectors will likely catalyze long-term structural changes in both the Chinese economy and the global market. As China grapples with its economic challenges, the focus may shift toward fostering a more consumption-driven economy, necessitating substantial reforms in economic policy and governance. Conclusion. The anticipated 25% decline in the real estate, manufacturing, and technology sectors by Q2 2025, alongside China's economic turmoil, heralds a period of significant change for global markets. Companies worldwide will need to adapt strategically, leveraging innovation, sustainability, and diversification to capture emerging opportunities. As economic dynamics evolve, the interplay of consumer confidence, geopolitical factors, and central bank policies will be critical in shaping the trajectory of global economic recovery. The landscape by 2025 is set to redefine competitive strategies with a clear emphasis on resilience and adaptability amid uncertainty.